Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hey everyone. So we have two different things today. One is to finish the lecture slides, and the other is to go through an Excel illustration of how fin trading and appraisal valuation can smooth returns, so understate risk, create serial correlation where it doesn't actually exist, and decrease artificially the correlation between different asset classes. So essentially we've spoken about that issue with things like direct property and private equity all the way through, but it's nice to actually see that taken to numbers. So if we start with the lecture, we finished yesterday, we'd spoken about sample means and we'd started on implied views. Now I've added a couple of dot points to the slide today, just because I realised with sample means in particular, I sort of gave you a heading and nothing else, so I wanted to actually put some explanation on the slide itself. So occasionally in the remainder of these slides, if you've printed it out, you'll see a dot point that I added this morning. Just write it in. I haven't taken anything out, so it's just the odd addition here and there. So remember, we said yesterday that one way of estimating the expected return next period was to take an unconditional view that the return next period will be the average of everything that's occurred in the past. That's what we mean when we say sample means. And we said that it was an issue for asset classes that have a clear time series trend, be that a drop in return or an increase. Which asset class was the big example that clearly violates the idea of not having a trend? AC, Australian cash, that's right. Remember, Australian cash, and in fact fixed income generally around the world, the returns have been going down for the past decade for short-term securities. For Australian long-term securities, there's been a downward trend for the last 20 years. So the idea that suddenly next period's return will be like the average of the past 30 years is like saying you're suddenly going to go and make back, 1 to 2 decades worth of rate cuts in a single year. It doesn't make sense. There are other asset classes where it's much more difficult to predict what's going to happen, where you can argue that returns might be closer to IID normal. If that's the case, if returns do follow something like a random walk, then it's fine to use an unconditional average like a sample mean, because there's no current information over the past few periods that would help you predict where you're going to be next period. So remember, sample means was done in Excel video 1. Sorry, Excel video 2 for the first 2 optimizations. The unconstrained optimization, so you can see here the mean is the average of what occurred in the past. And for the long-only optimization, you use sample means again. What you did in the last example is actually the Black-Litterman method, and I'm going to come back to that on the next slide. So let's say that you don't think that using sample means is appropriate. There's a couple of other ways you can go about estimating expected returns that we look at in this course. One of the big ones we look at is what we call implied views. Now, implied views is essentially using a model that's almost identical to the capital asset pricing model to figure out what the return should be for your different asset classes. So essentially, you're trying to find the equilibrium returns based on the model for a particular set of assets and how they co-vary with your reference portfolio. So essentially, you're going to specify a particular multi-asset class portfolio, and you're going to treat that as if it was a market portfolio. By doing that, you define that portfolio as sitting on the efficient frontier, like where the market portfolio would sit. And if it's on the efficient frontier, you can then figure out the expected return of each asset class using a model like the CAPM by saying the return would equal the risk-free rate plus the beta of that asset class with the reference portfolio times by what you expect the market risk premium to be. Now let me actually show you what that looks like. Some of you may have already looked at the Excel video for next week. Video 3, topic 4. No, I want the next one. Have I got it up? Video 1, video 2, video 3. Bear with me. Video 4. So the Excel video for next week, which is already on Wattle now, actually applies this implied views method of gaining expected returns. So this is what you get in the video. If I start with the actual mean for Australian equity, the actual mean is the implied views method, right? It's like saying that you think that the next period return is the average of the quarterly returns that have occurred. This is at a quarterly frequency. But instead of using the actual mean, you can estimate what expected returns will be through implied views by applying a CAPM model. What you do is you forecast a value for the risk-free rate. In this case, it's 0.6% per quarter, or approximately 2.4% a year. You forecast what you expect the market risk premium to be, 1% per quarter, or approximately 4% a year. And by the way, you can then back out what you expect the return on the market to be, right? Because the market return less the risk-free rate will give you your expected, your market risk premium. So, what do? Well, you say the return on Australian equity is equal to the risk-free rate plus the beta of Australian equity with a benchmark portfolio, I'll come back to that, times by the market risk premium. Now, you have defined your benchmark portfolio as having these particular weights. You can see that they have a reasonable spread across different asset classes to get your return series for the benchmark. And your beta, you just calculated the slope from a regression between Australian equity returns and the benchmark itself. So it's exactly like the CAPM, but you're doing it at a multi-asset class scale. So that gives you your quarterly return that you expect on Australian equities of 2.24%. The next question is, well, how do you reflect the risk in the strategy? Because the nice thing about just looking at the data is that you can use it to get your measures like standard deviation, probability of shortfall, probability of loss. You still can, and what you do is you essentially say, well, the history has given us a mean of 3.03%. I think a reflection for next period's return is 2.24%. I don't think that the historical distribution is wrong, I just think the returns are too high. So what you do is you take the actual time series of returns and you reduce each return by the difference between its actual mean and the return you expect. In other words, you expect a return of negative 0.79% less than its actual mean of the history. So you take every return that's occurred in the past and you reduce it by 0.79%. That way, this is the adjusted return calculation, when you take the average of your adjusted returns, you have 2.24%, which is exactly what you predicted it was going to be. So that is Excel video 4. It's the one that's going to be tied to next week. But if you want to get in and have a play around, it's already on Wattle. And it's a way of imposing what you expect returns to be using a model onto the historical data so that you can still calculate your risk statistics, your standard deviation, your probability of loss. It's one of those things that you'll understand a lot better when you get in there and play around. Once you've had a play with it, if you have any questions and you'd like me to go through it again, just let me know. Now, of course, the key to this actually working is the model is only as good as the benchmark that you define, right? Because you're defining risk as the beta between the asset class and that specified benchmark. If you create a benchmark that has really unrealistic or not sensible weightings, then of course your betas are not going to be a good reflection of the risk of the asset class. So if you use implied views, it's important that your benchmark is reasonable in terms of its asset allocation. That's one thing that's important to consider. But it does make mean variance optimization perform a lot better. Because what you're doing is you're making sure that the return of every asset class aligns with the risk in relation to a portfolio that's sitting on the efficient frontier. So if you do optimization on returns that are adjusted using implied views, you're going to get a very sensible allocation compared to something like sample means, right? Because sample means, remember, if you have an asset class, wrong one. If you have an asset class where you have much higher return given the risk compared to an alternative, remember, world fixed income had much higher return per unit of risk than Australian fixed income in the history, then you're going to start to get these crazy corner solutions. But just because that happened to be the return historically doesn't mean it's representative of what will happen going forward. And in fact, it shouldn't be, right? Because it would be relatively unrealistic unless there are hidden risk factors in world fixed income. So that's quite a nice method to use. For the assignment, I will probably give you expected returns to use. You won't need to actually use something like implied views to calculate them yourself. You'll have to adjust the return series in line with the expected returns I give you. But I probably will just give you a series of return that your investor believes is going to happen. That's what I tend to do in these assignments, and it's just because it takes one of those extra tasks away and enables you to focus on the concepts, the qualitative reasonings, and the fundamentals of the analysis. All right, now, number 3 we don't do in this course, and the reason is, well, for 3A in particular, you tend to focus on this if you're doing portfolio construction within a particular asset class. If you're trying to figure out the expected return for equity, you will use some kind of cross-sectional asset pricing model like what we did yesterday. Remember, there's Farmer French, there's Carhart, you could even use the CAPM. The alternative is that you could link whatever asset class it is, you could forecast their returns by linking it to the economy. So looking at things like dividend yield, growth in earnings per share, the change in price earnings ratio over time, growth in real GDP and inflation. Now, we don't do that model specifically, but we do in week 6 give some examples of some companies that do it themselves. They tend to be proprietary models. There's no one model to use. Different companies like Barrow, Northfield, they'll have their own models, but they'll often consider macroeconomic factors. You could also use a method that is just your own forecast. Now, you could, please don't for the assignment, because the important thing, if you're going to just come up with forecasts, you need to be an expert in the asset class. Now, we're going to spend a week on each asset class, but that is not long enough for you to be able to forecast what the returns are going to be without some model underlying it. But what investor forecast would be is like you saying, all right, well, I think if these are my asset classes, let's take this one. All right, I think that the return on Australian equity next period is going to be 8%. I think the return on world equities unhedged is going to be 9.5. World equities hedged is going to be 9. Listed property, pretty similar to equity, maybe a bit more, 8.5%. direct property, well, I'm going to focus on, value-added investments. So let's call that 10%. Commodities, 5%. Financialisation of commodities, the boom's running out of steam, so only 5%. AFI and WFI, let's call that 6% each. And Australian cash is low at the moment, so 2%, right? I'm just saying these numbers. I'm making them up as I go. Remember how I said at the start of yesterday, if you make an asset allocation and it underperforms, your investors are going to be hounding you and your bosses are going to be hounding you. The problem with investor forecasts is it's all about the justification as to why you did what you did. And it's a lot easier to explain a detailed model of forecasting, even if it's one you created yourself, than just to say, look, I understand this asset class, so I used my gut instinct to tell me what the return would be. Right? You could be very, very wrong. So it is a method that people do. It's not one I'd recommend, definitely not now, and even in general in the industry. If you're coming up with forecasts, it helps to have a model and reasoning behind it. And then you've got mixed estimation. So mixed is exactly as it sounds. You're combining more than one method. The one that you guys will do next week in your video is Black Litterman. That starts with implied views, and then it adds in the investor forecast over the top, but only for those asset classes that you have a lot of knowledge in and you believe implied views doesn't give an accurate depiction of expected return. So the nice thing about this is you have a model underlying most of the asset class expected returns. You don't need to be an expert in everything, but if you do have unique knowledge in a particular asset class and you think that implied views doesn't give a high enough expected return, for example, you can then adjust it. So to show you how that would work, remember, this is from next week. You've used implied views to get a bunch of different expected returns on your different asset classes. Let's say that you're an expert in world equities and you also are an expert in predicting how exchange rates are going to move. And you think that because of changes to the forward rate bias, we're going to look at this in week 10, you think that the return on world equities hedged that's coming out of implied views is too low. You think it's actually going to be a whole % higher than what implied views tells you. You take that return that was 1.9, you adjust it up to 2.95%, and that becomes the return from which you will adjust the historical series. So now you can see 2.95% is the average of your adjusted series. So you just come in and override the parts that you disagree with. Again, you want to have a good reason for doing it. Because the fact is, remember, under implied views, returns align sensibly with risk. So if you're going to add a whole % per quarter to world equities hedged, and you put that through an optimizer, what's going to happen to your asset allocation? Yeah, in world equities hedged, right? Massively. Now, if you have a good reason for thinking it's more attractive, that's not a bad thing, right? If you think world equities hedged will outperform, of course you're going to put a higher weight on it. But you need to be really careful. Have a look how sensitive the asset allocation is to that change. Because if the change in asset allocation is really big, right? If you had a 15% weight on world equities hedged, and you now have a 40% weight, you better be pretty sure that your investor forecast is correct, right? So it's important to weight it by your relative confidence in that forecast. So again, you won't be doing that one in the assignment, but it is a useful method and it's important to understand how to do it. Now, just a heads up, even though you probably, I won't ask you to use implied views in the assignment. I shouldn't be so sure because I haven't finished writing it, but I don't expect to. You will need to adjust expected returns. You've done it, you'll do it in next week's video. You also did it in last week's video. So I'll talk more in the workshops about which method of adjusting expected return is right for the purpose, but it is important to understand the approach that these videos are taking. All right, so that's methods for calibrating expected returns. The next thing we spoke about a lot already yesterday, and that's costs and alpha. Remember, the return series that you get, with the exception of 2 asset classes, the returns ignore costs altogether. What are the two asset classes you get that do incorporate a particular cost? Do you remember? Hedge funds and it was private equity. There's no reason that you guys would remember that. I just mentioned it yesterday. But yeah, hedge funds and private equity. In those two series, the data that I can download actually subtracts management fees. So they're with their post fee, but there's still other costs involved. When you have Australian equity and all of the other asset classes that aren't hedge funds and private equity, these are all before costs. So just because historically Australian equities have given a return of about 9% over this period, doesn't mean investors are getting 9% as a return. Some will be lost to transaction costs, right? The bid-ask spread, management fees if you're investing through a fund. Some will go to taxes, and that's going to vary between investors. So it's important to be aware of these costs, particularly because some asset classes will be more expensive than others. Illiquid assets tend to have higher bid-ask spreads, for example. Management fees are going to depend on the investor. Retail investors will pay higher fees than institutions. We're in a marginal tax system. Your tax bracket will depend on your taxes. Will alter the tax you pay. So it might seem obvious that you should be using after-tax returns. And in a perfect world, we would be. In fact, we'd be using return after all cost whatsoever. The trouble is, we're not in a world where we know exactly what cost to apply. We know the actual gross return of the different asset classes, so that data is accurate for the past. But most costs, we don't have a concrete amount that we would know to subtract. Some costs are priced by the market and we could subtract them. For example, in the same way that we can see a history of returns, we can see a history of bid-ask spread. So it would be very long-winded and complicated, but you could adjust the historical return series for bid-ask spread. Most of the time you can see management fees, so you could do the same. But what we're going to see in about week 11 is that if you're a large enough investor, some funds enable you to actually negotiate the fee you pay. They don't even quote a fixed amount. They let you negotiate one-on-one, because obviously they want your assets under management. So you won't know what to subtract. Think about things that are investor specific, right? Franking credits. Australia is a dividend imputation system, which means that if you are a domestic investor, if you're an Australian investor, if a company pays dividends that have franking credits, that reduces the tax you need to pay on the dividends, which is a big advantage to holding Australian equity. But if you're an overseas investor, you don't get access to the franking credits. You don't get that advantage, so you still pay double tax. If you're running a fund that has both domestic and overseas investors, what do you subtract for taxes? Even if everyone was taxes. What do you subtract for taxes if you're going to account for the effect on franking credits, right? Even if everyone had the same tax bracket, which they don't. Capital gains tax is another pain because not only is everyone in a different marginal tax bracket, but as we said yesterday, if you've held an asset for over a year, you get a 50% discount on your capital gain when you pay tax. But if you haven't, you don't get that discount. So it's really hard to know what numbers to subtract to take returns from gross to net. You're going to need to have estimation, which brings in an additional source of error. So what we tend to do instead is analyse investor-specific costs separately. And in this course, we'll do it at a qualitative level. Right? There'll be times where I'll tell you some specific fees to account for. Hedge funds and private equity, are post fees. But in general, it's enough just to be aware that these costs exist and that some asset classes are more expensive than others, which obviously is a disadvantage when you look at their attractiveness on a risk-return perspective. Now, I'm not going to go into alpha a lot today because we're going to go into it a huge amount next week, but I wanted to include it here as a flag of how the weeks tie together. So when you understand alpha a lot better after next week, come back and think about the fact that not only are our data excluding costs, but they're also excluding a breakdown between what's beta and what's alpha. In other words, you might have an asset class that has a really high return, but if you're just looking at the return figures, you don't know how much of that is because it's a really risky asset class and how much is because there's a lot of skill in the area. Right? So In something like equities, it's quite easy to differentiate, public equities I mean, to differentiate what's market risk and what's alpha, what's skill, because you have things like Farmer French, Carhart models. In things like direct property, when you get into the value-added or opportunistic direct property space, which we'll look at in a few weeks, the whole point of that is how to pick direct property assets to which you're going to completely renovate, maybe have a greenfield asset that you're going to develop from scratch. So there's a lot of skill involved, but because we don't have good passive direct property alternatives and we don't have very good representative direct property indices, it's really hard to split out how much of the direct property fund's return is due to taking on risk and how much is due to the genuine skill of the manager. So it's an issue with alternative assets in particular because it's hard to separate what's skill and what's risk. I'll go through that a lot more next week. So hopefully by now it's pretty clear that data is important and it's useful, but it has a lot of problems. And if you're not aware of the problems, you're going to have issues when you're using something like optimization to get an asset allocation. Here are some of the issues, then we'll talk about some things that you can do. The first we've spoken about, and that's new assets, right? If you have a brand new asset, you don't have a data history. It hasn't traded before. So how are you actually going to incorporate it into quantitative analysis? Chances are you're going to have to model what the returns might have been had it existed, which is going to require a lot of fundamental analysis, qualitative considerations, looking for an asset class that might be similar in terms of its key exposures, and from that, generating a potential estimated return series. But it is a huge estimation, so you're going to have a lot of error. There's illiquid issues with illiquid assets. I'm going to show you this in Excel in a moment, but remember, if you have illiquid or appraisal-based assets, you've got smooth returns, you've got serial correlation in the data that doesn't exist in reality, and I'll show you why later on. And you've got an understated correlation between asset classes, which make it look like a better diversifier than it really is. And I'll show you that too. We spoke yesterday about structural change, right? You might ask yourself, well, is data from the 50s and 60s and 70s actually relevant to today? Or back then was the market a lot more stable? And actually you might think that including those decades would understate the risk. But remember, I also said yesterday that luckily for you, most of the data starts in the 80s or 90s, so you don't actually even have the luxury of that choice. What you'll be doing is saying, do I use the full history that I have back to the 80s, or do I start at a period closer to today? It's up to you what you choose in the assignment, but I want to see a justification as to why it is. As long as that justification is sound, it's fine. But remember, you've got a trade-off, right? You shorten the data history, suddenly you have less data points to work with, which creates issues with the statistical power of your tests, and particularly if you're not running a bootstrap. You have latent unobserved risks. So one of these latent unobserved risks are risks that are important but don't appear in the data. Now, we spoke about one of them a couple of weeks ago, and that's a black swan, right? A black swan, you have no idea that it's going to occur because it never has in the past. If it never has in the past, it's not going to be in your data set. Here are two others. A liquidity black hole is essentially when everyone wants to sell an asset. No one wants to buy it off them. So no trades occur. Doesn't matter how much of a discount you want to make, no one's going to buy it. So you're left with a perm. Now think about it, at the extreme, a liquidity black hole, there are no trades. The liquidity gets sucked up into nothingness. If there are no trades, what's that going to mean for your data? Sorry? Yeah, it stays the same. You're not, even though actually you're in a terrible situation where you can't sell the asset, the price is staying the same because you're not seeing a trade occur. So at the extreme, even if you had a liquidity black hole in your history, you might not see it because you're not getting that huge drop in the price. You're not getting the haircut because everyone has a perm. You typically can see a bit of movement around it. Things get bad before a liquidity black hole and they recover from a low base, but they're also really rare. So you might not even have one in your data series, even in reality. So it might not even be about the fact that no trades occur. It might be about there was no liquidity black hole. but it doesn't mean it's not a real risk. And a good example is the credit markets in the GFC. Everyone wanted to borrow, no one was willing to lend for a certain amount of time. The Piso problem, or it's also called a Taleb distribution, it's been nicknamed the Piso problem because of the South American bond markets in the 70s and 80s. Argentina is a great example of this. Essentially what happened for these, it's better now, but for those couple of decades, let me ask you this. Let's say that you have a bond that gives a good return, a bond, okay, a government bond. Someone give me an example, what might you think would be a solid return, a good return for a government bond? What would you be happy with, hypothetically? Just throw ballpark figures. 6%, right? Okay, so now that's fair for our kind of markets. Now let's say that we're in a riskier market. What might that uplift? 10? Yeah, 10%, right? Argentinian bond market. Does anyone know what the returns were back in the 70s and 80s? They were 40%. 100 would be even more extreme, but pretty close, right? This is a bond, 40% returns. You'd be thrilled if equities gave you half of that right now. Okay, so Argentinian bonds were giving you 40% returns. And there were big periods in that history. It's a bond, right? It's contractual. If you don't default, you get that return. Where you were seeing 40% returns. Flat, 40%. So what does that look like? It looks like you've got the most incredible investment opportunity because you've got massive returns and no risk. The reality was there was a very good reason they were so high. There was a huge threat of nationalisation, of currency collapse, of the government completely defaulting and you not getting paid back. They were high for a reason, but if that negative event didn't happen to occur in your data series, you wouldn't know it just by looking at the numbers, right? Because there's no red flag there that says, you know, I know it looks good, but actually you could have all these terrible things happen, right? You're just downloading data. Now, Piso problems are different, though, to black swans, right? A black swan, you need to be a fortune teller to figure it out. A Piso problem, could you actually, if you look at the data, are there flags? Could you figure out that something might not be quite right and the asset class might not be as low risk as it seems? Sorry? The returns, right? Markets are relatively sensible. Humans, if they're going to agree to borrow at these interest rates, they're doing it for a reason. So the Piso problem, you don't need to be a fortune teller, you just need to be an investigator. Because the fact is, the returns were that high because of the risk. So just, if it looks too good to be true, it is, right? Just use your head and go, all right, there's no way that there's no risk. It's just that there is a drawdown potential that hasn't occurred yet. Okay, so even though the red flag won't be downloaded for you, common sense will tell you to look for it. Dig a little deeper and you'll very quickly realize there's a lot of risk involved, even if there hasn't been a collapsing event. And the last one to consider is large outliers in the data. So for example, let's take momentum. So momentum strategies, sorry, my belt's just broken, there we go. Momentum strategies give a pretty good return for equity markets in almost every country, not all, but most countries, and across most periods of time. So if you look at momentum strategies, they're one of those anomalies that for some reason haven't disappeared yet. But for just 3 months of 2009, momentum strategies in the US gave a negative 80% return, right? That's dreadful. This is a strategy that for the most part looks really solid. Suddenly you've got a negative 80% return. Now that's what you consider to be an outlier in the data. So what some people do when they see outliers is they trim them away, right? They remove them. Think really carefully before you do that, because what that outlier might be telling you is something about the event risk of the strategy. And in momentum, that's absolutely the case, right? Because with momentum, we're now looking at the second order, we're looking beyond the first order moment of momentum, right? So we're not just looking at mean, we're not just looking at volatility, we're also looking at things like skewness. Because it turns out that every so often, typically in times of unstable markets, momentum can cause terrible returns. Now, if you had trimmed out that observation, you'd think that it was fantastic, you'd follow momentum every time. And if you end up in a period like those 3 months in 2009, Your investors aren't going to care that it was really unlikely. They're going to care that you just ignored it and assumed it was never going to happen, and as a result, you've lost all their money, right? So it's really important to be very careful before you remove an outlier, right? If there's a really decent reason, if you think the data's dodgy, if you think it's not relevant and could never happen again, then you trim it. If you were only looking at momentum in expansions, it would make sense to remove the impact of recessions. But if you're looking at things in general and you think that that observation could repeat, don't get rid of it. So we've just said there are a bunch of problems. Here's some of the things that you could do to solve them. And we look at some of them mainly at a qualitative level, although we do actually look at modelling asset classes using other asset classes and things like that. The first one is if you don't have good data for a particular asset class, you can model it as a combination of other asset classes by looking at the fundamental nature of it. So you can look at an asset class and say, is it closer to equity or closer to fixed income? Or is it a combination? Does it have underlying risk exposures that are really similar to the underlying risk exposures of a different asset class? So when we look at hedge funds, remember I said you've got quarterly returns to the 2000s, but yearly returns go back into the 80s. What we're going to do with hedge funds is use a method where we're going to backfill those quarterly observations for that period where they're missing, so where you've got yearly but not quarterly returns. We're going to estimate quarterly returns by modelling the hedge funds as a combination of equity, bonds and cash. And we're going to make sure that that's going to create a split across the quarters that we're then going to reconcile with the actual yearly return to come up with an estimate for the quarterly series. Private equity, if you think that it's a liquid and so has smooth returns, well, it's not really a liquid, it's appraisal, it is a liquid, but it's appraisal-based valuations, right? So if you think that's smoothing out returns, and you look at public equity and private equity has markedly lower risk, but you go, look, really, at the end of the day, private equity is quite risky, you might want to model the risk of private equity like a geared public equity exposure. Geared because in private equity, you can take on a lot of leverage with things like LBOs, leverage buyouts. So these are all sort of choices that you might choose to make, or you could just go qualitative and say, look, I think the risk of private equity is understated. I think my optimizer will give too high a weight as a result. I'm going to bring that weight back down to manage my risk. There are ways that you could adjust the data series that you do have. So there are models out there to de-smooth the liquid asset returns. If you think there's a structural break, start your data after that break occurs. If you think there are outliers and you really don't believe they're representative of the future, then you can remove them. And the last thing that is included for completeness, but I don't recommend you do it in this course, or really ever, is make ad hoc adjustments. People do it in industry at times, but really it's because they have a lot of knowledge of the asset class and they were probably around to experience what happened. It's like if your asset class is unfortunately missing a year of data, you might fill it in based on what you believe would have happened. You really want to be careful before doing that. Please, nobody make an ad hoc adjustment in the course. It's something that's done, but again, remember, if you are asked to justify it, you have no leg to stand on. So the last thing to remember is you're going to be dealing with uncertainty. We've shown that through the course. You have parameter uncertainty and you have model uncertainty. So you need to be aware of it at all times and just use your wits, right? Use your brain, ask yourself, is it too good to be true? Because if it looks too good to be true, it probably is. You're going to have parameter uncertainty because you're only estimating the expected returns, variances, covariances. So you need to be aware of how sensitive your estimations are to your outcomes, right? So if you've modeled expected returns, ask yourself, if I used a different method, how different would my asset allocation be? If it's similar, then you're confident that it's probably relatively sensible because even if you tweak your parameters, you're coming up with a decent asset allocation. If small assumptions have wildly different outcomes, you need to be very careful that you're using the right method, that you've justified it, that you're confident that you've made the right decision. Model uncertainty, and in this course, a more accurate reflection would probably be method uncertainty as well. Remember, it's only a model. It's not going to reflect all of the complexities of real life. So what you want to do, if you can, is avoid relying on just one model or just one method, right? Don't just use a bootstrap on yearly returns, use hypothetical quarterly analysis. Double check, use more than one method of adjusting your return series based on the expected returns that you have, although that would probably sit under parameter uncertainty. The idea is if you can get a similar outcome using multiple different methods and multiple different ways of estimating your parameters, you have a lot more confidence that what you're proposing is reasonable because it's not sensitive to one or two small choices. So this is just essentially, as you go through that accounting for uncertainty, this is what you do with yourself. You ask, what is best given my objectives? Look carefully at the inputs and look carefully at the outputs, trying to find red flags. Is there too high a weight on a particular asset class? If something looks wrong, it probably is. So look harder, find the problem there. Maybe it's a piezo problem, for example. Maybe you've overestimated return per unit of risk and your optimizer has gone to a corner solution. So it's all just about thinking. It's about applying that overlay of common sense through your analysis. Now I'm going to show you an example of what happens with data smoothing. Just quickly, I want to say one thing about the reading, and that is you've got no examinable reading this week. You've got one massive supplementary reading. Even if you never look at it you look at it if you're interested at the moment on how to estimate returns on the different asset classes. But if you think you might end up in the industry, just save it to a hard drive because it's actually a really deep, I mean it's 100 pages, but it's a deep look at how you might model the expected returns across assets. In terms of announcements, I'm going to put up from the 17th a progress check on Wattle. It's essentially a bunch of different multiple choice questions. It's not for marks, right? It won't affect your grade whatsoever, but it will give you a bit of a gauge on how you're going, and it will give you a bit of practice with some multiple choice questions. There's only one, I think about 8 questions, I can't remember, but everyone has access to the exact same questions. You can do it with other people if you like, but what I recommend is you do it on your own, in an exam style environment, right? So don't have all your books ahead. Try to put yourself under a bit of time pressure, like you'll do with the practice mid-semester exam, and just check how your understanding's going. It just gives you a bit of a gauge on, for a few questions, how you're feeling with the material. The mid-semester exam timetable is available. I'm not going to tell you the time because I'm so paranoid that I'm going to get it wrong and someone will turn up at the wrong time. So have a look for yourself. It's in week 6, that one I'm sure about. It's in week 6, and I'm going to give you a past mid-semester exam next week. I only give one in this course because it's not a course where going through mid-semester exams are going to help you, right? It's conceptual. So for every question I give you as a past question, it's just a question I can't give you. So your exams become harder the more mid-semesters I give you. I'll explain that next week. But the key to you, I would still do the past mid-semester, just to give you an idea of how the exams look in this course. All right, so let's have a look at what happens when you have either an illiquid asset or an appraisal-based asset when it comes to estimating risk. What you have here is 3 different property investments. You have a liquid REIT, you have an illiquid REIT, and you have an unlisted property fund. So you have appraisal valuations once a year. Now, all 3 assets have the exact same underlying fundamental values. Okay, so the true values of the 3 asset classes are identical. It's obviously a simplified example, but it's really good to show you what happens. Now, let's say at time 0, all assets are priced at their fair value of $1 million. At the end of the first year, a shock occurs that brings true value down by 10%. So it was 1 million, it's now 0.9 million. The liquid REIT is traded enough that that full drop is realized at the time, right? There are still, it is a negative shock, so there are more sellers than there are buyers. The sellers do need to drop the value in order to get someone to purchase it, because that's what happens when there's a negative shock. The assets are worth less. But there is enough trading in the market for it to properly, accurately reflect the decline in value at the time. And then it just stays at its fundamental value of 0.9 for the rest of the series. The illiquid REIT, and we're assuming here that people are not willing to take an unfair haircut. They're going to roll out their trades because there aren't enough buyers willing to take a reasonable price. Right, so the illiquid REIT, you start to sell it when the shock occurs, but there aren't enough buyers, because it's illiquid, to do everything at once. So the price drop is more gradual. You get down to 0.95 at time 1, sell a bit more, go down to 0.91 at time 2, 0.9 at time 3. So you finally manage to sell everything, and value is reflecting its fundamental value after 3 years, and it stays there for the rest of the series. The unlisted property fund has just had its last valuation. That was at its fair value of $1 million. So at time 1, there's no more valuation. Nothing changes. It stays exactly at $1 million until finally at the end of the year there is a new appraisal, and then instantly the value drops to its fair value. But it's done it 11 months too late. So if you have a look, if you look at the full 12-month return, it's 10% in all cases. It's accurate because you're taking it over that full window between the appraisal valuations. But have a look at what happens if you were to calculate returns in that window, say 1, 2, 3 months in. Calculate the return 1 month in, and it looks like liquid REITs are doing a lot worse than the other two. Illiquid REITs are doing worse than unlisted, but not as bad as liquid. And unlisted is doing great. No negative return whatsoever. Add another month, and now, okay, listed is still doing badly. It hasn't quite caught up with the liquid REIT. Sorry, illiquid REIT is doing badly. It hasn't quite caught up with the liquid REIT. The unlisted property fund is still sitting at a 0% return. After 3 full months, the price drop for both the liquid and illiquid REIT has been compounded into the price, but the unlisted property fund is still sitting with no loss whatsoever. So look at the standard deviation. It looks like the liquid asset class is the most volatile, the illiquid REIT is less volatile, the unlisted property fund has no risk because the price hasn't changed after 3 months. So you can see this is what we mean by smoothed returns. It understates your volatility. It also understates the correlation between asset classes because it looks like illiquid and unlisted, the illiquid REIT and the unlisted property fund do not have a perfect correlation with the liquid REIT. So it looks like you can combine them to lower your risk. But in reality, they all have the same fundamental value. It's just not being recorded in the price. Right? So it now looks like you've got understated risk and overstated diversification potential. And I've put that there. Have a play around with this example, because this shows what happens when you start to move into a world where you have multiple shocks, which is more realistic. Value changes. Now we've got a shock in period 1 to 0.9, period 5 further down to 0.7, and period 9, it goes up a bit to 0.8. It's always reflected in the price for the liquid REIT. It gradually is reflected in the illiquid REIT, but the returns are smoother. I'll show you a graph in a tick. And nothing is reflected in the unlisted property fund. It just goes to 0.8 after 12 months. So even though value is fluctuating, you can't see it in the returns series. So you can see, again, we've got understated standard deviation and overstated diversification potential by understated correlation across the asset classes. And when I talk about smooth returns, focus on the illiquid REIT in particular. See, because the adjustment's gradual, the true line in the red, this is true value, is being smoothed out, which is lowering the standard deviation. Unlisted property, just nothing happens until the end. But remember, all three in this example had the exact same underlying fundamental value. So this is why I say the influence of things like fin trading and appraisal valuations, it's not as bad as the horizon lengthens. It's still there, but it's not as bad. You get to capture the full return series. You'll still have understated risk, but it's not as extreme as if you're using very small intervals and, more importantly, might actually be sitting when an appraisal hasn't yet taken place. Okay, so typically lengthening the period in general is good, and then what this example doesn't do is lengthen the measurement interval, because if you lengthen the measurement interval as well, you're going to get rid of that lower standard deviation and serial correlation even more. So that is why we do things like put a maximum weight on direct property if we're not going to adjust the series. Yeah.